All right, continue our look at it now, closing in on 20,000 again. It had backed away from it, gotten really, really close, and now close again within 24 points of that elusive level. If that surprises you, it surprised our next guest as well. Moody's chief economist Mark Zandi had predicted a downturn. Now, Donald Trump was elected. Now he's predicting a good economy, I would assume a good market for a while. Mark Zandi with us right now. Mark, what happened to change your mind?
Nothing, Neil. That analysis you're referring to was if during the campaign when Trump came out with his proposals, he got exactly what he proposed. So he proposed $9 trillion in tax cuts over 10 years. He proposed tariffs of 45% on China. He proposed that the 11 million undocumented had to leave the country. So we took that at face value and ran that through our models and methodologies. And if he got exactly what he wanted, he would get a recession. But, of course, he wouldn't get exactly what he wanted, and we'll see exactly what he does get. But a very different kind of analysis. So nothing changed.
All right, but is it your notion, then, that the tax cuts he's envisioning, cutting regulations, whatever he wants to do with repealing, replacing, correcting, fixing Obamacare, is enough to propel the kind of thing we're seeing right now?
I think if he focused on corporate tax reform, meaning lowering marginal rates and making that deficit neutral by getting rid of the loopholes in the code, if he focused on infrastructure spending, and if he focused on some changes to some regulation on Dodd-Frank, Obamacare, energy, then yeah, that would end up, the economy would end up in a pretty good place. If, however, he also does focus on limiting trade, if he calls the China currency manipulator and forces them to allow their currency to float, if he focuses on restricting immigration, if he has big tax cuts and spending increases that are deficit financed, then no, the economy will be in a worse place. So really, we don't know. We'll have to see, but it depends on what he puts his focus on.
What do you put your focus on when you look at the market and you look at the economy? What is leading what here?
It's moving in both directions. So we have a fundamentally strong economy. I mean, the unemployment rate is 4.6%. We're creating a lot of jobs. There's a record number of open job positions. Layoffs are at record lows. So fundamentally, the economy is very good. And that obviously is very good for stocks. But the run-up in stocks since the election, that does reflect optimism about some policy changes. So if we have corporate tax reform and you lower marginal rates on businesses, and we're talking about pretty sizable declines in marginal rates, you're raising their after-tax earnings, and that's really good for stocks. And if you say, oh, I'm going to deregulate the financial sector, I'm going to pull back on Dodd-Frank, we don't know what that means exactly, but let's just say it reduces the amount of capital or liquidity the system needs, then that's good for financial stocks, and that's, of course, the key sector that's been driving stocks higher. So it's both. It's a good economy, and it's expectations of some policy changes that will help the stock market in particular.
You know, we're watching, as you're speaking, Mark, you know, this quest for Dow 20,000. We're within about 18, 19 points of that. These are big levels, and obviously this would be one of the shortest jump from 90,000 to 20,000 of any 1,000-point jump we've seen in history. But what do you make of what the markets are saying right now, and whether this is a case of buying on the rumor and the prospects of a President-elect Trump, and maybe once he is president, selling off?
Oh, well, I mean, I think the market is reflecting the fact that, you know, again, we're fundamentally in a pretty good spot, and it is pricing in some expectations about future policy. And, you know, valuations are very high, even though the economy is good and corporate earnings are strong. If you look at current prices relative to earnings, they're high. I'll give you a number. So on average, historically, the price-earnings relationship in the S&P 500 is 15. It's currently 20. That's on the high side of fair value. So, you know, in that context, it is going to be very sensitive to any disappointment. So if we don't get corporate tax reform, certainly to the degree that the market anticipates, if we don't get infrastructure spending, if we don't get some deregulation, then there's going to be disappointment, and the markets will adjust, and they'll adjust very quickly to that because they are very, very highly valued. They're pricing in really good news, and if they don't get really good news, then the markets are going to be softer.
Do you worry when you see markets go nonstop like this, and as we're in and out of the 20 points or so away from 20,000, this idea that people are getting their hopes up? It's good to see, obviously. I mean, but that they welcome interest rate cuts where before they feared them. They're okay with a strong dollar where before they feared the impact on big U.S. multinationals. What's going on here?
Well, no, I don't fear it. I mean, I think if the markets started to feel speculative, if people were buying simply because the prices rose, last month and last year, therefore they're going to rise next month and next year, and we saw that, and people were leveraging up to make the purchases, and it's not just the stock market, but let's say it was in the real estate markets or what other asset markets, or if there was speculation, then I would get very worried about that. I don't think markets are speculative. I think they're highly valued. The stock market today feels very highly valued, but it doesn't. So I'll send off a yellow flare. I wouldn't send off a red flare. I mean, only if we had that speculation, I think it would become potentially an existential threat to the economy. I don't see that, at least not at this point.
All right, Mark, thank you very much. Mark Zandi, Moody's chief economist.